Welcome to the Dividend Talk podcast, episode 57 German Perspective to Dividend Growth Investing. Hey guys, welcome back to another episode of Dividend Talk. I'm your co host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Hey, it's the weekend and I'm here with European DJI. How are you, buddy?
Really good. Great to see you. And thank you for sending over the rain towards European mainland.
You're welcome, because we're getting all the sunshine and I'm burnt to a crisp here, but I love every single second of it. We don't get it too often over here. But hey, we have a really cool show today. We have David on the show. How are you, David?
I'm fine. Thanks for having me.
Really excited to have you here. I follow your blog, even though it's in German. Google Translate does a great job, I must say. But for our listeners out there that may not know, can you just maybe introduce yourself just a small bit?
Yeah, thank you very much again for having me here. My name is David Frank. I'm 35 years old. I have a wife and two kids who are already 5 and almost 2 years old now. I do live in a suburb of Cologne in Germany, where I studied finance at the local university. And nowadays, I am working for one of the big four companies in the political risk management department, where I support German companies with their foreign direct investments in places like Africa, Asia, and Latin America. However, that's not the reason why I'm here today, because I also started a blog, my own personal finance blog in 2017, which is called Jung in Rente, which I guess nobody of your listeners will understand, but which literally translate to early retirement in German. And on that blog, I describe why I want to achieve financial independence as soon as possible, which has nothing to do with my job, by the way. And how I will do it, namely by saving as much money as possible and invest it in the stock market, whereby I guess the unusual thing about my blog is that I report my actual financial numbers, which has become rather common nowadays, but wasn't when I began the blog in 2017. Yeah. So thanks for having me here, and I'm really curious about our discussion in the next hour.
Yeah, we both can't wait. And as you said, I follow your blog, and it is quite common now to post numbers. And we'll get onto all that fun stuff when we start asking you questions. But what interests me there is when you say you're chasing financial freedom, but it's nothing to do with your job. I really like that, because I'm similar. But when you have a job you like, I find it so much easier. You're not reliant on that. But as I said, we will discuss your investing style, and we may touch on some of these subjects. But before that, we might jump into some news. Have you got anything for us this week?
Yeah, when I had a look at the news from this week, there were two headlines that jumped on my eyes. The first one was Daimler, the German car manufacturer. I don't know if you've read the news. The Q2 EBIT numbers were released, and they were much better than the estimates for this quarter. And I think all divisions of Daimler performed very well despite the shortage in chips that were in the news like over the last couple of months. And I think Daimler did a really good job in the recent past to cut costs. However, that came with a price. Everybody heard that 10,000s of jobs were lost, not only at Daimler, but at many car manufacturers, especially in Germany. And a lot of employees were sent to short-time work because of the chip shortage. So overall, a mixed picture, good financial numbers, but that came with a price, I would say.
Yeah, that's always the downside of the capitalistic system, right? Shareholders benefit, but many people that are on the receiving end as employees, they are not in the favorable situation. I mean, I find this news quite amazing, right? Because we know how much the car industry is under threat. We also know how the rise of Tesla just a year ago was making everyone think like the car industry is dead. And then you see these numbers. It just shows how great these companies are, how much tradition they have, and how they can pivot under these kinds of times, right? And it's really amazing for me when you see this. And the same with Volkswagen, how it's picking up on electrical vehicles. It's really amazing. And this also shows you that you usually don't need to take all the risk by being the first one. Usually the market has enough in there to just copy what the new entrant is doing if it's not a winner takes all market. And I can tell you, nobody wants to have a Tesla if all the other 99% of the road is having a Tesla. There's enough space for different brands.
Yeah, I see this just like you just explained. However, I watched the whole progress of the German car industry with a laughing and with a sad eye, just because I had shares in Daimler and BMW some time ago, and I sold them right at the bottom, and now I see how share price is trending upward again, and I'm not part of that, and so yeah. I had a really bad timing with that one. However, yeah, that's just like stock exchange work, right?
Exactly. Hey, and EMF, did you add anything in the news?
Yeah, of course. Walgreens announced earnings again. We all know I love Walgreens, so I had to bring them up. Actually, the third quarter of growth, which I quite enjoy. Earnings per share was up. They bet expectations by a good margin. The only downside for me was the really small 2.1 dividend raise. I was expecting maybe 4 or 5%. I know they're being a little bit on the conservative side. They've got a new CEO in there who's probably just trying to get everything in order. And what surprised me, and I missed this in the news before, was that they partnered with Uber Eats. So I need to do a little bit more reading up on that. But that seems quite exciting. I don't know how much it's going to be worth tomorrow, how beneficial, but it seems like a positive step in the right direction. So overall, I was happy. Just kind of wish that the dividend increased a little bit more than what it did, but solid from them again.
Well, from that point of view, there's still like a 4% yield, right? And if you believe in the future of Walgreens and that it's a turnaround story from that point of view, then this might actually be an interesting entry position.
Yeah, they have dipped actually recently because of the Amazon fear again. Amazon are going to take over the world and every market they go into. So it's probably a good time to start buying when people start to fear Amazon coming in. So yeah, I'll probably add to them again pretty soon.
I like these Amazon narratives because that's why I was able to buy Ahold shares at the time for 16 euro or something like that when Amazon was wiping out every grocery chain. So
yeah,
cool.
Okay, and there was one more. You mentioned two pieces of news, David. Did you? You had something else?
Yeah, the second headline that came to my mind was also from Germany. Industry company Siemens, who I guess you guys know, split up last year into the industry part and the energy part. And yeah, the energy part was quite positive in the news during the last couple of months. Share price went up to, I guess, 34, 35 euros a share. However, now, a bad headline catched my eye because they had to do a big downgrade on some of their wind energy projects. So Siemens Gamesa, the renewable energy part of Siemens Energy, had to do some downgrading with their projects, and the new estimates for the EBIT for 2021 are around about zero. And beforehand, the estimates were around about 350 million euros. So yeah, both share prices of Siemens Energy and Siemens Gamesa tanked yesterday by more than 10%. Yeah, and now when you have a look at the recent share price, it's almost back to its IPO level at 22 euros a share. Yeah, which everybody can make up its own mind how that is going to develop in the future.
Yeah, I believe the cost of raw materials has dramatically increased. I know it has in Ireland and similar in Europe, which is drove up prices from, which obviously is affecting the bottom line. So if you believe in the company, it might be a good price to get them at compared to earlier in the year.
So I'm still having those shares because I got them with the spin-off, and that was also, I believe, the reason why Siemens technically had a dividend cut at the time. And I believe Siemens Energy doesn't pay a dividend yet, right? It's still without a
Not
dividend,
yet.
indeed. Yeah. So I kept them in the hope that it will start paying a dividend one day. So let's see. But I find it a really interesting development, and I like their assets that they have. So really looking forward for future dividends here.
Yeah. We're still really early in that energy phase, aren't we? So there's still, it's more than a decade out is your time frame there. It's not a 1 or 2 year project. So I would hold on tight, European DJ, keep tight. Okay, so what we might do is we might do the rapid fire round. I don't know if you've heard this before, David, but we will just ask you 5 questions. We haven't told you what they are beforehand. Don't look so scared. They're not they're not too bad. And you just answer them straight away, and then at the end you can reflect on 1 or 2 if you wish. So I'll give it over to European DJ to ask the questions.
So we know that you own both stocks, but you need to choose one: AT&T or Verizon.
Ooh, okay. That's a tough question. I would go with Verizon.
Good. Then the next one: winning the World Cup with Germany in 2022 in Qatar, or 100% dividend increase from Coca-Cola.
Oh, okay. I think I take the second one.
Coca-Cola. Great.
The last win of the World Cup is not yet that far away. So 2014 it was. So yeah, I think I take the 100% increase in my 100 share Coca-Cola position.
Cool. Good. ETFs or individual stocks?
Both.
You need to choose one. Sorry.
Okay. Then ETFs.
Good. Fresenius or Munich Reinsurance?
Fresenius.
And then the last one: the German social system, so high tax, but also high security, or the American social system, lower tax and hardly any social security?
I would say the German one, just because of its really, really amazing health insurance system. Yeah.
Cool. Thank you.
Cool.
Is there anything else you would like to clarify further on, or?
No. I don't think so. Too many difficult questions at a time. I would have to think too long about them to answer them correctly.
I'm curious about Verizon over AT&T. That one was curious to me.
Yeah. Okay. I think the investment case for AT&T is not as clear to me as the one of Verizon, just because of the planned split up of the businesses of AT&T. I think maybe in 1 year there's more clearance about that, and then I would say maybe I would go for the real AT&T, where when it's focusing only on the telecommunication sector. But for now, I think I would definitely prefer Verizon, because their focus is just much higher on the actual business, and it's not blurred by all the media stuff.
Cool. Thank you. So, David, we have you here on the show, of course, also to learn a little bit more about you as an investor, and also about, I think there's interest also how it is from a German perspective, right?
Mhm.
So let's get into that, because my first question is actually, how did you become a dividend growth investor, and specifically, what was the first moment that you discovered it? And do you still remember that? And could you describe how you felt at that moment?
Yeah, to be honest, dividend growth investing didn't come to be by nature. I was an ETF investor since late 2008, right when the financial crisis hit the hardest. I invested all my money in a diversified ETF portfolio, and I kept it for quite some while and earned some good money with it. I really liked the whole ETF story because, from an objective point of view, it's just the right thing to do. However, a couple of years later, I guess it was 2015, maybe 2016, the ETF story just became too boring to me. It was just like putting money into ETFs. There is no real relationship to this funds. And then I heard from my best friend who was investing in Shell shares at the time, how good the dividend was, and I had a look at it, and a deeper look at it, and a third look at it, and then I decided to buy my first individual shares, and it was actually really Royal Dutch Shell, my first equity investment. And yeah, so I became a shareholder. I fall in love with dividend investing. And then, yeah, 3 or 4 years later, I started to switch a little bit from the dividend investing to the dividend growth investing, because I just realized that dividend growth stocks have just a much higher share price appreciation than dividend stocks with a dividend yield of 6% or 8%. Oftentimes you just see the share price stagnating at a certain level, but with dividend growth investing, you get the best of both worlds, I think.
Yeah. It's really interesting that you say that, because I think there's often a misconception indeed between dividend investing and growth investing. Because with dividend growth investing, I think the emphasis should be even more on growth. Yeah, because
Exactly.
it means like you have a sustainable business that is increasing sales, increasing earnings, and hence the dividends are also way more sustainable, right? And with that, you can beat inflation as well.
Yeah, I think especially when you have a really long time horizon, dividend growth investing is much more attractive, because, of course, when I saw Shell yielding, I don't know what it was at the time, maybe 5% or so, it looks attractive at first, but even at that time, Shell didn't increase its dividend anymore. So you were capped at this yield when you initiated your position. But when you invest in a company with a starting yield of, let's say, 2 or 2.5%, but you have real growth behind it, and it will grow like with 5% or 10% on an annual basis for years to come, then I think it's the much better deal than just looking for the sheer yield.
And is I know in Ireland it's not really a culture over here, dividend growth investing. In actual fact, it's not quite common. But is there a culture of this in Germany? Is it common for dividend growth investing in Germany?
It's a really difficult question, because I think you have to start even before asking, is there like a dividend investing community in Germany? Because the whole stock culture in Germany is not really in place yet. I guess I saw a statistic that less than 20% of all adults in Germany hold shares at all. I guess that has historical reasons. At first, because of inflation and the whole past, especially in the last century, we had a huge share or stock market disaster in the early 2000s, when one of the largest German companies, Deutsche Telekom, the German telecommunication monopolist, had its IPO, and many Germans invested in it. And first, the share price only went up, and then it fall down. And I guess many people lost their appetite for stocks at all during that moment. But I guess nowadays, especially with the upcoming of some discount brokers, investing got much cheaper, and a lot of young people started to invest. And what I'm seeing since the early 2020s is that more young people invest in shares, and not only in growth stocks but in dividend stocks as well, just because nowadays there is no more interest rate at the bank, and a lot of young people are asking themselves what to do. They cannot expect to get a lot of money when they are at the age of retirement or of real retirement. So they make up their mind, and oftentimes they decide to go to the stock market to invest in shares, and oftentimes it's dividend shares or dividend stocks that they invest in. So I think there is a good development, but a real dividend investing community is not yet in place, I would say, in Germany. Although sometimes when you're in a bubble like we are, like at Twitter and FinTwit, in the blogging scene, you sometimes get the impression that everybody is investing in dividend or dividend growth stocks. But I think when you talk to people in real life, it's not really the case yet. I don't know what you think about that.
So what would they typically invest in? Is it pension funds, housing? If not the stock market, where do they typically put their money?
Yeah, if I have a look at my old mates from school and university, most of them invest in real estate. Although it's rather expensive nowadays in Germany too, but they still say, okay, I don't know anything about stocks, so real estate is the real thing, and it's much safer. Although, to be honest, it isn't, at least in my mind.
It's similar to an Irish perspective. It's pension funds and real estate. I don't know if you remember the Celtic Tiger when Ireland was booming. Yeah. Everybody was buying houses, but there was a huge crash in 2008, and a lot of people lost a lot of money, and it seemed to scar them a little bit, but they're still getting back into houses where there's this misconception about the stock market, where they're scared to put the money in theirs that's riskier, even though they both hold the same risk. So it's interesting to hear that there's the same mindset deep within Europe as well.
Yeah, so looking at my Dutch roots, I'm just born and raised with "Thou shalt save for a later day." Yeah, and you don't put in the stock market because you might lose it. And then how you said, I've not been born and raised with compound interest and these kinds of topics. So if I look at my family and friends and such, it's all about saving and buying a house and then thinking about your house as your future retirement, but also a lot of trust in the government and your future pension. And I put a comparison the other day, and over the last 10 years, we lost 19% almost on inflation because there was no re-indexing of pensions. So people, compared to 10 years ago, the promise, compared to now, they lost almost 19% of their future obligations, which is insane. Yeah. So if we then talk about saving and safety, nobody made 19% on their savings account over the last decade. So everyone just lost almost money. So for me, it's kind of, this culture is hurting us a little bit. And what I'm scared of is that this money printing of the ECB pushes people in the stock market because there's no other way, might not be educated. And I sometimes wonder, like, when does this vicious cycle stop, right? Where does it stop? That we go back to normal, that effectively it's kind of robbing the people, right? That are not playing in the stock market. And they're taking now on additional risk by going in the stock market, while they might not be educated for it or something like that. I'm really wondering how this will end up.
I echo that fear, and in particular, David, you mentioned young people starting to get into the stock market. And at the moment, we can see valuations are high. So the likelihood that a crash is going to happen within the next decade is quite high. We don't know when, but these young people getting in may lose more money than what they think for a short period of time. And my fear would be that somehow scares them, and they never want to get involved. They take their money out at a loss, and they stay away from the stock market for a long time.
Yeah, that's exactly the scenario that my parents' generation faced like 20 years ago with Deutsche Telekom, when everybody was just up and cheering for shares and everybody wanted to have them in their portfolio. And then the stock crashed, and it only left a burnt field, and nobody wanted to invest anymore in stocks. And yeah, we saw that in our education as well, that only few people in my age really got taught by their parents that investment or investing in shares is even a possibility.
Yeah. Well, having said that, let's go back to our little bubble then. I'm wondering, what are actually the most well-known household names when it comes to dividend growth stocks in Germany?
Yeah, I guess because I'm mainly investing in large caps, only they are really on my radar. First of all, there are the insurance companies. First of all, Allianz, and then secondly, I would say Munich Re. Although there is a third huge insurance or reinsurance company called Hannover Re, which is a bit smaller than Munich Re, but still has the same business opportunities. Both of them are not really in the dividend growth department, I would say, because they already have a high yield. I guess Allianz and Munich Re are both yielding above 4% still, although their share price appreciated a lot in the last year. But at least both companies hold their dividend really steady during the last decade, or in the case of Munich Re, even for the last 3 decades. So I would say everybody who starts investing in Germany have those 2 insurance companies in mind. Then I would say another typical sector is healthcare. You mentioned it in the question round already. Fresenius and Fresenius Medical Care. The holding company with its 4 departments, Fresenius, and the dialysis specialist Fresenius Medical Care, who's mainly operative in the US. Those 2 are, I would say, typical dividend growth names, just because both titles don't really had large dividend yields during the last 20 or 30 years, but they steadily increased their dividend. Fresenius for the last 29 years, for the Fresenius Medical Care, its subsidiary, also for more than 20 years now. So I guess those 2 would be typically named when you would ask in Germany, which is a good dividend paying company. And at last, I would say there's also SAP, the IT company, the software company. Same thing as Fresenius and Fresenius Medical Care. A long tradition of raising dividends, but not a huge yield. Share price came down last year a lot from its all-time high. However, still the yield, I guess, is somewhere around 1.5 or 2%. I don't know exactly where it stands as of today, but still a good dividend growth name, and I think a lot of potential for future dividend increases. Have you heard of them? I guess so.
Well, actually, yes, almost all of them are part of the Noble 30 index. So while you were mentioning this, I was watching. So, for instance, the longest dividend growth streak, or at least no cut, comes from Munich Re, 51 years. I think they have frozen their dividends over those time 2 or 3 times probably. I think the financial crisis and time before. So it's always been growing, but SAP is in there with, I was able to track down 28 years of dividend growth. I don't know from before that. I couldn't find from the early 90s. But yeah, all those are in there. And I was not surprised, but Henkel is also a company there. But those are the ones that are probably not associated at the moment as a flourishing business, let's say.
Exactly.
Yeah, no, so these German stocks are well represented in the Noble 30 index. I believe that Allianz had a cut in 2008, if I remember correctly, around the great financial crisis. That's why they're not in there.
Yeah.
And actually, I bought some SAP shares on the dip last year as well, around 90 euros, I think it was.
Very good timing. Yeah, I re-entered the position as well. I sold it almost at the high and I bought it back at the dip. This was one of my luckier timings, I would say, not like with the German car manufacturers, as I said at the beginning.
Yeah, I remember writing a post about it, and it was quite controversial because everyone hates SAP, right? Everyone that ever has touched SAP hates the company. But for me, it is kind of the best mode that you can have. Everyone hates you and they still can't get rid of you.
Exactly. I guess there's just no real alternative yet, although there are so many companies that want to compete with SAP. But then at the end, almost everyone sticks with the system because I think it's just so expensive to change systems. So I guess SAP will have a bright future, especially with its new CEO and the new strategy that we see coming.
Yeah, and at least it has time to transform, right? Because you can't just get rid of SAP overnight. So any industry changes, they have some time to still catch up with the cloud movement, as example.
Yeah, exactly. I think SAP was rather late to the whole cloud thing, and they tried to accelerate its business in the cloud. And I think it is starting to work, but I guess it will also take some more time to complete.
Okay. One of the questions we get quite a bit from Europeans is tax, dividend tax. What is the tax like from a German perspective?
You know that Germany has the biggest tax system in the world, so it's not as easy to explain, but I will try to make it as light as possible. So as a German investor, when you start investing, you really don't have to care about taxes just because there is an amount of around about 800 euros that you can have in capital gains or in interest or in dividends that are tax-free. So the first 800 euros are free of taxes. But afterward, you have to pay a standardized tax, which is round about 26% on all capital gains, on dividends, on interest again. It gets a bit difficult in relation to withholding tax from other countries because it works fine with all nations that Germany has a double taxation treaty with. As long as such a thing is in place, 15% of the withholding tax can be calculated in our national German tax. It gets a bit problematic when the withholding tax of the country of origin is higher than 15%. Because then you would have to go to the financial authorities of the foreign country and try to get your the withholding tax that you paid over this 15% rate back from it. And as you might know, there are countries where this thing is easy or easier, like for example Switzerland. And there are many other countries where it's rather difficult to get this additional withholding tax back. And this is the reason why many German investors kept or are keeping their investments in countries like, let's say, the UK, in Germany, Switzerland, where it's easy to get the additional withholding tax back, or the US. Although the US has a withholding tax, I guess, of 30%, but there is an agreement with the German brokers that you can say, okay, I am a German investor, don't put this 30% withholding tax on my bill, don't only put it on 15%. So you don't have an advantage when investing in US stocks, which is very good, because if you can invest in German stocks, in stocks from the UK, in stocks from the United States, and stocks from Japan, I guess that's pretty much enough to build a very nice portfolio for you.
And then, so I know that Germany has a really good relation with Switzerland, because for non-Germans it's much harder to deal with the Swiss tax office. Personally, I'm now also claiming my German taxes back, which is also not easy. A lot of paperwork. So the German government could still, in my opinion, digitize a little bit and make it more digital.
A little bit.
Yeah, that's the statement. Yeah. But what I wanted to ask is more technical. So if you have a 0% tax from the UK, or 15%, let's say, from the Netherlands, do you still need to pay the additional 11% in Germany on top of that? Or is it like, no, 15% is the cap and you don't need to pay any change from a German point of view?
So let's look at an example. If I have a stock from Denmark, like I have Novo Nordisk in my portfolio, I don't know exactly how much the withholding tax in Denmark is, but it's higher, I guess, than 30%. So only the 15% from the double taxation agreement is calculated in our German tax for dividends, and everything above 15% is calculated on top of our national tax. So then you pay like 40% taxes on dividends from Denmark, which is not nice. So you have to go to the financial authorities in Denmark again to get it back. If you can get it back. I think I'm a shareholder of Novo Nordisk since 2016, and I've never seen a single cent coming back from me from the Danish authorities yet.
Let me give you an example from a Polish point of view. So if I buy shares in Germany, I get taxed 26% via the broker. According to the double taxation treaty, I need to pay 15%. So let's say the other 11% I can claim back from the German tax office. To your point, it's not easy, but it's now enough that it's worth the time investment. But on top of the 15%, I still need to pay 4% additional, because the Polish withholding tax on dividends is 19%. So if I don't claim my tax back, I pay 31%. Yeah, so you see again that every country has their own tax system a little bit.
Yeah, I didn't even know how high the German withholding tax for foreign investors is. But if I understood correctly, it's exactly like the 26% that we pay on tax.
Yeah.
Okay,
So
I
it's
see.
also the social contribution on top of
exactly.
that.
Yeah, 25% plus that. Yeah. Okay,
Yeah.
I see. Well, I've learned something. Good.
Well, I think Swiss tax is what most people hate, with the 35%. I think they're the worst in Europe.
Yeah, but I don't have any stocks from Switzerland in my portfolio somehow. I don't know why, but I've heard from many other German investors who tell me like it only takes like a couple of weeks to get the additional tax back. So I think that is pretty easy to get back in return.
Nice.
Yeah, it's time for Europe to standardize it, isn't it? We might see that when this new tax regime comes in. Hopefully they'll standardize all this and make it so much easier for us.
Oh, that would be so nice.
I tell you, I bet a beer on this that we are retired already by then. Yeah,
You're
financially.
I'll take that bet.
Yeah.
Yeah.
Okay, good.
Okay, let's bring it a little bit lighter. We'll come off tax for a few minutes, and a little bit more of a personal question. So, as an investor, what has been working well, and what have you been struggling with?
It's also a rather difficult question. However, I would say the thing that has worked the best for me was sticking to my original plans and investment cases. And every time when the clouds get darker on the investment horizon, and you think about maybe selling a share because news are all about it, and everybody's only telling negative things about the company or the industry, you should ask yourself if your investment case still stands or not. And I experienced exactly this a couple of times in the last 5 years, I would say, where I got nervous about the whole news situation, and did the wrong thing, and sold the corresponding stock. And afterwards, as I said, like with the German car manufacturers, or there are different or other examples, like, for example, Walgreens or its competitor CVS Health, where I get also nervous, or didn't stick to my investment plan long enough to give the whole investment case time to work out. And I would say, as a long-term investor, you just have to put time in it and give everything time to work out. I would say that that's the thing that I've learned most in the last couple of years.
Yeah, sometimes I think the broker should implement something that you can only hit the sell button twice a year. Yeah, and you need to have double security, like only if your wife also hits the sell button. Yeah, like I think this is the best fail safe for emotional decisions like that.
Yeah, it's funny you say that, because last week on the show I mentioned I always see myself as a buy and hold investor, and we did a review of our quarter, and I had quite a busy quarter where I sold a lot more than I thought I did. So I think it's so easy to say, oh, I'm going to buy and I'm going to hold it forever, ever, and ever. And then something in your mind changes, and it is hard not to sell sometimes. So I feel you on that one. I'm trying to work on that as well, not hit that sell button. So I think you're right, European DJI. Maybe give my wife access to the sell button. Although she might sell too quickly. I don't know.
No, but just 2 times a year, right?
Just 2 times a year.
So, and then for that means also 2 stocks, not 30. But David, I also know that last year during the financial crisis, you went full in. I remember that because I was following your blog and I saw how much money you threw at it, and I think that must have been for you like a child in the candy store, or not?
Yeah, I think that's the best description of it, because I saved a lot of money during the last 10 years, just until March 2020, exactly for such a crash. I just waited for it and waited and waited. And my feeling got worse and worse about that, because I had so much liquidity on the side. And then it finally happened. I mean, the circumstances were not nice. I mean, nobody wished for such a pandemic. However, the stock market reaction was just perfect for my plan. And so, as you said, I went all in and put 100K into the stock market and just bought everything that got under my fingers. And I got really happy with it. And so, yeah, I initiated a lot of really nice positions that in retrospective, I can be really happy about it.
I think so as well, and that's putting how you say it, money where your mouth is. I think they say it in English.
Yeah.
Or is it putting your mouth
Yeah,
where the money is? Something like that. Yeah.
Yeah, I actually love hearing that. It's so rare to see someone with a plan, and in times of panic, sticking to that plan. So that is amazing. Well done to you for that, because I don't think too many people will say it, but I don't think too many people will implement it like that. So that's worked out pretty well for you.
Good. Maybe the last question before we go to the listeners' questions. What would be your main advice for beginning investors?
Yeah, I would just say, go and get started. Just start to invest. Maybe not with an individual stock at the beginning, but install an investment rate of maybe 50 or 100 euros a month, and just put it into a widely diversified ETF. and just look at it after 1 year and see how it worked out for you, how you felt when the price is going down, when the price is going up, and how you maybe get interested in the whole topic. I saw it with my brother-in-law. He is a couple of years younger than my wife and me, but he had no interest in money and investing and saving at all. But now he's earning enough money to have a good savings rate on his own. And on my advice, he started to invest in one or two diversified ETFs. And he just got hit with the investment virus. And now I think his portfolio already hit like 5 figures. And he's really passionate about it, although he only started like, I guess, 2 years ago. But it's just working. You have to get started. You have to put money in it and then see how you react with it. How if you're nervous when prices are going down, or if you get too happy when prices going up, and then after a while decide if it's the right thing for you or not, and then make a final decision.
Great, good advice. So let's go to the listeners' questions then, David. And maybe the first one is always Phil. He's always the first one in the show. He is our German native Belgium friend. So here it comes. Imagine that your broker is going to run a scheduled maintenance tomorrow night and you can't access your account for 1 year. Which orders will you place tomorrow morning?
That's a good one. But I guess I would just do nothing, because I'm actually nowadays pretty happy with my portfolio. However, I think I would have a look at my liquidity. Maybe I can do 1 or 2 more investments before the stock market is closing for 1 year. But apart from that, I guess I would change nothing at all.
What would you do, European DJ?
I would sell a put option on, for instance, the S&P index, 30% lower from this, at least still gain some additional money. And then if it's in a year 30% lower from now, I will buy some. So I will probably do that still, at least to get the maximum out of it.
Yeah, that's a good idea. It's a good idea. Okay. Tiago asked the question. You might have covered this already, but are there any tax benefits that investors based in Germany can take advantage of to reduce their tax burden?
Actually, as an individual, I guess there are no options to lower your tax burden. If you would want to lower it, you would have to go with a known company and put equity investments and so on in it, because I guess there are certain kinds of legal entities that pay a much lower tax burden and tax rate than individuals do. But I'm not really familiar with this topic. So as an individual investor, and I guess Thiago is asking for for the individual investor's perspective, there are no additional tax benefits that you can get in terms of capital gains or dividends or interest.
Yeah, and I think he's asking about legal options, right?
Well, I hope so.
Yeah, because otherwise you just open a broker in the UK where you don't pay dividend tax and you just don't give it up to your local tax office. But I think that's illegal, so we shouldn't advise that.
Yeah, I mean, okay, if you think about like that, I mean, there are legal options. For example, I have 3 brokers, and one of them is Interactive Brokers, and Interactive Brokers is not a German broker, so I don't pay the local German tax right when I sell something and have capital gains, or when I get a dividend, and I have like this money with which I can work for a year or a little bit more until I report my tax file to my local financial authority, and then I have like to pay taxes 1 year ahead. But so you have the money and the liquidity a little bit longer on your side, and you can work with it. But the tax rate is still the same in the end.
Yeah, it's a little bit how Warren Buffett always talks about insurance companies, right? You get the premiums first, then you gain some interest on those premiums before you need to, pay out on the how I say it on the claims or something like that, and you get to keep the difference. And this is a little bit what you're saying, right?
Exactly.
Yeah. Great.
Cool. Rep Stones has asked, have you any thoughts on the ticker QYLD? That's the covered call ETF, I believe.
I am out. Haven't heard of that ticker before.
European DJ?
Yeah, it's a really popular ticker because I don't know, last time I checked 11% or something like that yield.
Yeah, double digits.
Yeah, I don't play with this stuff. It's for me too risky. It has nothing to do with dividend growth investing. I'm staying away from this. This is like the same as going into, I said the VIX index or something like that, where you're trading on speculation, and I'm staying away from it.
Is it this covered call fund?
Yeah.
Okay, I see. Okay, I've heard of it. Because when you mentioned the high dividend yield, I remember that somebody in the Twitter community told me about that.
Yeah, it's the latest buzz on Twitter. It used to be AT&T under 30, and now it's high yielding QYLD. So, I mean, I get the attraction if you're chasing this really high yield or you're getting 11%. It looks really attractive. I don't know enough about it. I typically stay away from those things. It's 11% for a reason. There's obviously an associated risk. I just don't know what that risk is, so I tend to stay away. And plus, ETFs in Ireland is a pain, so the tax is a disaster. So I tend to stay away from them altogether. Okay, Jens has asked us a question, and do you have any thoughts on SJM or AOS? Ticker SJM or ticker AOS?
Yeah, actually, SJM. So Smucker is, I think he's talking about the US producer of jam and stuff. I have them, or I had them on my radar for quite some while, and I think I was almost initiating a position in it last March when I put that much money in the stock market. But somehow other positions got initiated first, so no money was left for Smucker. However, I think it's a great company. I think it's a really specific field that they are operating in because it's rather small, but they are one of the key, or they are the key player, at least in the US. And I still look at them every once in a while, and I can still imagine that one day they will enter my portfolio if the share price is right.
Yeah, I like Schmucker as well. I bought them last March, and when everything went dipped, I've sold them after. I think they doubled in share price afterwards. I bought them for that reason because I knew their share. Well, I didn't know. I believed that the share price would rise. I do like they have a good history, but I had some concerns around their debt profile. The growth is a little bit tricky for me. I only see growth through acquisitions, which is working quite well for them. I know they've moved into the pet food business a little bit as well, but it's always risky when your main growth drivers is acquisitions because you have to buy them, take on lots of debt, and then take on that risk of integrating that in. So at this price point, I'd have no interest in them. They are a good company, but I'd buy them again if they dipped another, like they dipped last March. But no, I can certainly see the attraction, but not at the moment for me.
So the next question, David, is from our friend and YouTube star Dividend Check.
Very good.
And he's asking, how does your risk management look like? So I guess he's interested in how you manage your portfolio from a risk point of view.
Great question.
Yeah, that's a really great question because, to be honest, my risk management was a disaster until early last year. because there was nothing like risk management installed. So I went all in, and then I questioned myself if some positions, got too big, because you must know that my largest position at the time was ExxonMobil, and I think I invested around about 40,000 euros into ExxonMobil shares, and I just asked myself, is this the right thing? Can I still sleep well at night? And that wasn't the case with such a big position. Same goes for some position that I still have in my portfolio. For example, Royal Dutch Shell, where I still have like 10K invested, or Southern Company, where the amount is pretty much the same. So with new positions, my rule is that I don't want to invest more than a certain amount per stock, which is in my case 2,500 euros. Which is the maximum investment that I will do with new investments, and I have also a boundary, a limit for the industries. So I don't want to invest more than a certain amount. In my case, 12,500 euros per industry, so that I don't invest more money, for example, in the tobacco industry or the oil industry or whatsoever, so that I don't have this large risk which could materialize all at once if things go bad. So yeah, that's my kind of risk management for new positions. It's a bit hard, I think, to overlay this risk management with your old positions, because then there is a history with your shares that you have in your portfolio, and it's sometimes it's rather difficult to say goodbye to them, which is especially the case with Royal Dutch Shell with me, just because it was my first position and I just fall in love with it, and I still think it's the best managed oil company in the world, and I love Shell's CEO, and I still believe in the investment case. I have a smaller position in Shell than a couple of months ago, but it's still a really large position. But I think I will hold on to my shares for now.
I think we're both having the same opinion on Shell, so I also didn't sell it after the cut. And actually, I'm quite bullish on Shell if we look at the current environment. They've significantly reduced their cost per barrel. So, and now with the current, I said oil price, I've got a lot of hopes in them. I think I see the dividend that they did. I didn't like it, but I also see the bit as the great reset. Like, one good reset, and I can't imagine almost that in the next decade that they would do another dividend cut, unless the oil industry really gets wiped out. Otherwise, I think this was a once in a decade dividend cut.
Yeah, I think that the dividend cut was really a bold move of Shell and Shell's management and Shell's CEO. I didn't think of it as a bad thing at the time, but when you saw like the dividend yield dipping, like 2/3 of it were lost, and then there was also this huge capital depreciation in a matter of weeks,
Exactly.
all came at once, and this was just like a scenario where I ask myself, it was the right thing to put or so much money into just one company. But nowadays I'm happy with my position and the position size, and as you said, I think Shell has a bright future. Oil prices look good at the moment, at least, and but you still see a lot of pessimism about the oil industry and its change that has to be made with all the climate discussions going on. So I don't know, maybe 2 or 3 years back, when oil prices were at this level of $70 or $80 per barrel, I think Shell's share price was a bit higher than nowadays. Maybe almost twice the price that you have to pay now for the share.
Yeah, I think it's a result of ESG investing. And actually, I don't mind. It's the same like tobacco stocks, right? They have a low multiple because of this being a sin stock, and oil stocks are sin stocks nowadays. But if you look at something like Philip Morris, it has created a lot of shareholder wealth over the last 2 decades. And I see for the oil companies a similar future here. I don't see them wiping out. If many people go out, it will have a pressure, I think, on the share price now, but over time that will normalize. And then if that keeps having a low multiple, it gives us nice dividend reinvestment options if we want, or at least decent yields if you want to start investing. So it's a good thing actually if it's not so attractive. The cash is more important, the cash flow. Cool. And there's one more question that we would like to ask today, and maybe this is also good for you, Juan. Der Aktieninvestor, you might also know him from Twitter. He has behind it Der Nie auf Berater hört. And he says, I have a strong opinion about the European Union and the United States, but I can't really build an opinion about China's stock market. What are the expectations in middle and long term for China?
Yeah, that's so difficult to answer just because there are so many recent developments going on and a lot of recent block building, especially since the relations between the US and the European Union are starting to pick up pace again. And yeah, I can't really answer the question on a political level, but I would say like Chinese companies have a bright future, however it will look like. But seeing like more than 1 billion consumers in China alone, it's such a huge market, and I see no scenario where there is no more growth in China alone, let alone all like the export activities that are going on in China. And yeah, I just initiated my first position in a Chinese stock. I just invested or initiated my first position in Alibaba like a week or two ago. And yeah, maybe you can see from that activity that my own view towards China is not like very negative.
Cool. I have a slightly different opinion. I don't really like the Chinese market. The risk is too much for me. So I know you're similar to European DJI. He has Alibaba as well. So I wish you both the very best of luck with that one.
Thank you. We'll let you know. We'll post those screenshots of Alibaba at 300 in like a year from now.
Yes, and you can replay this snippet over and over again.
Exactly.
Okay, so we're coming up to one of our listeners' favorite parts of the show, and that's our stock pick of the week. As our guest, we would like to invite you to choose a stock maybe that you like or would not necessarily recommend, but you would like our listeners to know about.
Yeah, thank you very much for the honor to introduce my stock pick here. I would go with a German company, but not with one of the large names that everybody is aware of, especially in Germany, but also maybe towards your European listeners. I would go with Encavis. Encavis is a renewable energy company, but not from a manufacturer point of view, because Encavis is operating renewable energy projects all over the world. They've just installed a really huge one, I think the largest one in their recent history in Spain. And I like this business because it's a steady business. They operate those solar parks or whatsoever, and they get a payment which is written in a power purchase agreement, and they have a really long like investment and planning horizon. They can say, okay, we have like for 15 years or for 20 years or even for 25 years, we can exactly see how our cash flow will be, and that's I think especially for dividend growth investors the best case that you can find, just because it is so predictable. And we talked a little bit about ESG when looking at Royal Dutch Shell from a negative point of view, but here, like with Encavis, it's the complete opposite. We have a player here that is not as large as many other companies that are well known, so there's a lot of growth potential hidden. And especially concerning all this ESG stuff, I think Encarvis has a really bright future ahead of the company. I'm already invested in that company. Just as a disclaimer, however, I plan to invest even more in the coming days, weeks, or month, because the share price is looking really attractive to me. The yield is round about 2.5%, I guess, at the moment, and the share price is at 15 euros. However, we already saw share price at a little bit more than 20 euros in 2021, when all renewable energy companies had its all-time high. The stock dipped a little bit since then, but the investment case is still intact and still in place. And I really believe in that company, especially because it's coming from the town where I lived for the last 8 years, Hamburg in Germany. And they know where the wind is coming from, just right next to the Northern Sea. And so I think it's the perfect place for that business.
Yeah, great. And also to our listeners, you wrote a blog post about Encarvis, just about the dividends that you received to us. So I'll put the link in the description so that they can also look it up.
Thanks.
But actually, because of you, I got in touch with this name, actually, because once you posted the blog, I think it was like 2-3 days ago, I started looking it up, and I was quite surprised about it. So it might be one of those, how you say it, those little gems out there that not so many people know about, but can create a lot of shareholder wealth in the upcoming decade. Yeah. Great.
Yeah, I'm just looking at them there now and translating them into English. They look really good. Energy sectors, as we said, is something I think over the next 10 years is going to do really well. So it's an area in the engineering field that I'm quite familiar with. So I'm going to dig into these and read your blog post as well. So thank you for that. We like hidden gems here. Stay away from companies we all know. So that's a really good choice. Okay, so that's the end of the show. That kind of zip by. Thanks a million for coming on, David. It's been a pleasure to have you to share your story, your journey, and your investment thesis as well. It's been an absolute pleasure, and thank you for coming in to share that with us.
Yeah, thanks to the two of you for having me here. It was a really great pleasure for me. It was a lot of fun also to discuss with you all the things that we talked about. So thank you very much, and maybe we can repeat it one day.
Definitely. We'd love to have you on again. And we have a community. I know we shared this before. We're starting to write this European Investor Network, and we would maybe love to have you write on that someday, and maybe spread your knowledge to more Europeans. So we look forward to that as well.
Yeah, I would love to.
Okay, so thank you all, and I wish everyone a great weekend. Lots of fun investing next week again. Earnings season is starting, so I bet you that next week, Friday, we'll be talking about quite some quarterly earnings reports. So everyone, great weekend. Cheers.
See you next week.